I'm afraid you are the sickest man in the United States. You have everything. All of your diseases are in perfect balance. Here's what happens when they all try to get through the door at once.
So what you're saying is, I am indestructible.
We're going to see a leak out of the reverse repos into the money supply because of rising interest rates, and that is going to add even more fuel to the price inflationary fire. Hey guys, Rafa here from the End Game Investor, and today I wanted to go into an obscure issue that could very easily blow up the monetary system this year. You see, when the Fed raises interest rates, typically that slows the rate of monetary growth, slows the rate of monetary inflation, which is what eventually has an effect on consumer prices. This time, however, there is so much money backed up that's trying to get into the banking system that raising rates will open the floodgates to this money that hasn't even yet entered the banking system. These dollars came into existence through quantitative easing that has been taking place since March 2020, but they've had nowhere to go, so they are being stored back at the Fed, and there are currently about 2 trillion of these dollars with nowhere to go that will have a place to go once interest rates are hiked, and that will expand the money supply by even faster rates than we've seen so far. So what I'm saying is there is no way for the Fed, for the Federal Reserve, to control the money supply expansion rate anymore. In other words, the Fed has no way of actually tightening monetary policy in the sense of slowing the rate of monetary inflation. It is now literally impossible, and raising rates is only going to expand the money supply even faster. Let's go into the details. See this chart, guys? This is a chart of reverse repos. A reverse repo is when a bank has too much cash and cannot store it, and it's too expensive to administer. So it takes that extra cash, gives it back to the Fed, and the Fed gives the bank 5 basis points in interest. We see here, reverse repos began as a thing in 2003. They were very, very low. And we see here that in 2008, during QE1, they showed up on the map a little bit, 20 billion, not so much. And then in 2014, with QE3, when they pushed their balance sheet up to 4.5 trillion or whatever it was, they started to become a thing consistently in the 100 billion to 300 billion mark, depending on quarter ends or year ends, when they would typically spike, when banks have to balance their books. And then when QE stopped around here, and they started shrinking their balance sheet, reverse repos went back to fairly low numbers where they were originally in the early 2000s. But then we had March 2020 and QE starts again. And a few months later, you start to see this enormous pile of what is now about $2 trillion in excess cash that cannot get into the banking system. This is money that's being flipped back and forth between the Fed and the banks and is not going anywhere into circulation. Why? It has to earn 5 basis points. But here's the thing. When interest rates rise above 5 basis points, then there is going to be room for this money to move into something that leads it into the economy, into the banking system. So once interest rates start to rise, this money is going to start flowing in. And yes, it is true that the Fed can try to counteract this by raising the reverse repo rate, by enticing the money to stay in at the Fed, by paying more money to keep it there and out of the banking system. However, they will not be able to absorb all of it. Some of the money will enter circulation through short-term T-bills, which is where the people that have this money, mostly money market funds, are going to want to put it in to keep their money market funds going. So some of the money might be absorbed, but not all of it, and this is going to start a flood. There is evidence that this flood has already begun. We'll move to an article by Alistair MacLeod of Gold Money, who describes how this process may unfold in the coming weeks and months. In an article entitled Money Supply and Rising Interest Rates, Alistair MacLeod Right. A reverse repo is the other side of a repo transaction. If a commercial bank has too much liquidity on its balance sheet, it can use a reverse repo to provide it to another bank in need of liquidity on profitable terms. But if the Fed is the counterparty to a bank or eligible institution in a reverse repo, then the liquidity is being taken out of general circulation, reducing money supply on a short-term basis. Therefore, an increase in the Fed's reverse repo book reduces the M2 money supply figure below what would otherwise be reported. So all that money in the reverse repos is not in the money supply, it's stuck at the Fed. Now McLeod tries to explain what happens to the money supply when interest rates rise, given all these trillions stuck in reverse repos at the Fed. We now turn to the consequences of rising interest rates on the money supply and the impact on government funding. There seems little doubt that as rates move above the zero bound, so long as T-bill rates remain above the Fed funds rate minimum target, that money funds will no longer use the Fed's reverse repo facility. Indeed, earlier this week, a jump in the yield of the 13-week T-bill to 0.085% has already coincided with a reduction of $400 billion in overnight reverse repos. From the money fund's viewpoint, the risk of breaking the buck disappears as the Fed funds rate moves above zero bound, and a purchase of short-term T-bills becomes an increasingly profitable alternative. These money funds are likely to increase their buying of T-bills, which will be credited to the government's general account at the Fed. The funds gained in the general account will be subsequently drawn down and spent by the federal government, when they will then be reflected as bank deposits, adding to M2 money supply. Here's basically what McLeod is saying. You have T-bills and you have money funds. Money market funds need to have a net asset value of 1 so that people put money in it and they don't lose their dollars. This is where money that's in brokerages goes when it's not being invested into stocks or bonds or whatever. They go into money funds. Now, in order for a money fund to stay solvent, it has to be able to return money. So its operating expenses cannot be more than the interest that it earns on whatever short-term investments that it's buying. And so when short-term T-bills go up because the Fed is hiking rates, then money market funds are going to buy the T-bills. Where does money that is used to buy T-bills go? It goes into the Treasury's account, the Treasury General Account, which the government uses to spend money. So all these reverse repos will start flowing out of reverse repos at the Fed. They will flow into short-term T-bills. The government will then have that money, spend it on whatever the hell they're spending it on, and then it goes into circulation. We're going to see a leak out of the reverse repos into the money supply because of rising interest rates, and that is going to add even more fuel to the price inflationary fire. There is nothing the Fed can do to stop the money supply growth rate now. It is just going to go higher and higher. The question is, where will that money go? Will it go further into bubble stocks and meme stocks and bonds? No, it's going to go into consumer prices and inspire even more spending. The ball is rolling, guys. The only question is, how fast is it going to roll? And how big is that ball? And how long will it take for the banksters running from it to get squished? This is Rafi of the Endgame Investor. It is looking increasingly likely that a hyperinflationary scenario is unfolding throughout the world, including the United States. As this unfolds, things are going to get volatile everywhere, and you're going to have to maintain emotional balance in order to get through it all. In this time, please consider subscribing to the Endgame Investor for a 2-week free trial to see how I handle all this. And if you want some bonus material, you can sign up as my patron on Patreon, where I give a weekly discussion into libertarian ideas that come from the Bible based on the Jewish Torah reading cycle. This is a commentary that I'm working on based on medieval sources, and you will enjoy it if you value the ideas of liberty. Have a good week, everyone, and I'll see you soon.